Master valuation to avoid 90% of junk stocks. 90% of people who trade stocks lose money. The root cause isn't a bad market, but their failure to understand even the most basic concept of valuation. So, what is valuation? In simple terms, valuation is determining a reasonable price for an asset. Think of buying apples at the market. You know that normally, a pound of apples costs about $8. If the price tag says $50 per pound, you definitely wouldn't buy it. Investing works the same way. Assets like stocks, funds, and real estate all have their reasonable prices. Valuation helps you calculate this price and judge whether the current market price is cheap or expensive. Let's take a real-life example. Suppose you want to open a bubble tea shop but aren't sure what the business is worth. You calculate, the renovation cost $100,000, the equipment cost $50,000, and it earns $20,000 profit per month, with potential for even better performance in the future. You add all this up, factor in the risks, and finally arrive at a price you think is reasonable. That's valuation. Now, consider stocks. One person might believe a company will make a lot of money in the future and think its stock is worth $100. Another might see high risks and value it at only $50. These different price assessments represent different valuations. Therefore, valuation isn't fixed. Different people can arrive at vastly different figures. Furthermore, valuation isn't just about the present, the equipment, the cash in the bank, it also involves estimating how much money it can make in the future. So, what about the total market capitalization we see on trading platforms? That's the market price to buy the entire company. For example, if a company has a total market cap of $1.84 trillion, how is that calculated? It's simply the current share price multiplied by the total number of shares. Valuation, then, is what you believe the company is actually worth. After using various methods to calculate this value, you divide it by the total number of shares to get what you consider a reasonable share price. Why is valuation so crucial? If you lived through the 2015 Chi-Next bubble in China or the 2000 dot-com bubble in the US, you would always keep valuation in mind. In 2015, the A-share market experienced a frenzied bull run. At that time, many Chi-Next stocks had PE ratios exceeding 100. Going back to the bubble tea shop example, if your shop earns $100,000 annually, but someone offers $10 million to buy it, that's equivalent to a PE ratio of 100. Just 6 months later, the Chi-Next index plummeted from over 4,000 points to around 1,500 points. Investors who ignored valuation and bought at the peak saw their account values halved. In 2000, there was an internet company whose main business was developing browsers. Its stock tripled on its first day of trading, and its market value surpassed that of many traditional companies with decades of history. However, this company had almost no profits. Its valuation was purely driven by hype around concepts like the internet changing the world. After the bubble burst, stocks of many similar companies fell by over 90%, wiping out countless retail investors who had followed the trend. These cases illustrate one truth: investing without paying attention to valuation is like crossing the street blindfolded. You might avoid disaster for a while, but an accident is inevitable sooner or later. A classic theory, the walking the dog theory, perfectly illustrates the importance of valuation. The owner represents the intrinsic value, and the dog represents the market price. Sometimes the dog runs ahead of the owner, sometimes it lags behind. But no matter how far it runs, it eventually returns to its owner. Intrinsic value refers to how much profit a company can generate, the assets it owns, and its future growth prospects. The daily fluctuations and volatility of the stock price are like that dog running back and forth. Valuation helps you find where the owner is. This way, even if the dog temporarily runs far away, you know it will eventually come back. You won't blindly chase rising prices out of FOMO, nor will you panic and sell in a downturn when prices fall. Many people think valuation sounds too professional and is difficult for the average person to learn. In reality, the most basic valuation methods are quite simple. Let's take the PE ratio as an example. What is it? The PE, price to earnings, ratio is one of the core valuation metrics in value investing. It measures the relative value of a company's stock. Simply put, it helps us judge whether a listed company is undervalued or overvalued. When we often hear that a certain stock's valuation is too high or its price is too expensive, it usually refers to its PE ratio being too high. Let's use an example to understand the PE ratio more intuitively. Suppose a coffee shop goes public successfully, with a market capitalization of $4 billion. This coffee shop sells 100 million cups of coffee a year, with a net profit of $5 per cup. Its annual net profit is therefore $500 million. The coffee shop's PE ratio would be $4 billion / $500 million equals 8. If you wanted to buy this entire coffee shop for $4 billion, it would take you 8 years to recoup your investment through profits alone. In the stock market, the PE ratio equals the share price divided by the earnings per share, EPS. For example, a TTM PE ratio of 23 here means it would take 23 years to recoup the investment based on current earnings. You can also use 1 divided by the PE ratio to estimate an earnings yield. For instance, 1/23 is almost equal to 4.35%. Now that we understand the logic and calculation of the PE ratio, we need to distinguish between the trailing PE ratio and the forward PE ratio. Which one should we look at? The trailing PE ratio, often labeled TTM, equals the company's market capitalization divided by its net profit over the last 12 months. This ratio more closely reflects the company's recent, actual performance. The forward PE ratio equals the company's market capitalization divided by the forecasted net profit for the next 12 months. This is an estimate based on future expectations. Generally, a lower PE ratio suggests a cheaper valuation, while a higher PE ratio implies a more expensive valuation and greater market optimism about the company's future. So, the question arises, is a lower PE ratio always better? From a buying perspective, a low PE is generally better than a high one. Essentially, this means it's better to buy when the valuation is cheap. Note, cheap here refers to the valuation, not just the share price. The PE ratio itself is a valuation metric. Looking at its formula, share price/earnings per share, we see that because of the EPS component, a low share price doesn't automatically mean a low PE ratio, and a high share price doesn't necessarily mean a high PE ratio. However, this doesn't mean a low PE ratio always indicates a good investment opportunity. Conversely, a high PE ratio doesn't automatically mean a stock is a bad investment, as the market involves much uncertainty. Investing in low PE stocks can be akin to hunting for bargains. It often requires strong value judgment and analytical skills to identify truly undervalued gems and potentially earn significant profits. Another scenario is when the PE ratio turns negative. This indicates the company is losing money. In this case, the PE ratio loses its usefulness as a valuation tool. If a stock's PE ratio is significantly higher than the industry average, it could mean the market has high expectations for the company's future profitability. This might be due to unique competitive advantages, high growth potential, or the company being in a rapid expansion phase. However, a high PE ratio can also be a signal that the stock is overvalued and requires careful assessment. If the high PE is supported by genuine high growth potential and strong future prospects, and you have confidence in the company's future, it might be considered for investment. If the high PE lacks reasonable fundamental support and could be driven by speculations that might change, it might be wise to avoid or exit. Right now, you can pause for a moment. Think back to the last fund or stock you bought. When you purchased it, did you know its PE ratio? Did you understand the average valuation level within its industry? If you didn't know these things, you were essentially investing based on gut feeling, not much different from flipping a coin to decide. Alright, that's all for this video. See you next time.